the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Welcome back to the podcast, everybody. Episode 84 today. We are going to dive into a very interesting and specific topic on today's show. We're going to look at those top tax strategies for low to mid income households. That's households averaging roughly 100K and below in annual taxable income. But before we do that, as always, let's take a brief moment and thank our episode sponsor.
Hi, Chris Piccurrio here, founder of Teaching Tax Flow, co-host of the Teaching Tax Flow podcast, and pickleball enthusiast. Yes, if you listen to the podcast, you know almost every episode we talk about pickleball, the most popular and growing sport in America. We have tons of opportunities for paddles and pickleballs, but we don't have a lot of great gear on the market. Well, I'm so excited to announce that Sunsets and Dinks are now a sponsor of the Teaching Tax Flow podcast and produce amazing gear, not only to look at, but you feel confident on the court. Because you are part of the Teaching Tax Flow community, you get a 15% discount on all your orders with them. I know I love the gear I received, and I have quite a good record while wearing it. Believe it or not, even at my level. Go to teachingtaxflow.com/pickleball and simply enter TTF15 in the serve up promo code area of your paddle rack.
All right, everybody, let's jump into today's episode. As mentioned there in the intro, in the title, and in the description in the show notes there, which you probably didn't read. So we're going to tell you about it anyways in a little bit more of detail. But before we do that, too, we have to welcome the bald guy back with all the knowledge. Chris Piccurrio, what's happening, man? How we doing today?
I am doing great, John. I'm going to put you on the spot, and you love when I do that because you do that to me with your tax questions.
Oh, boy. Here we go.
The number 84 has a very, very special place in my heart. Can you guess why?
84. I don't know, actually.
I'm thinking probably because it's such an obscure number. It's the last year the Tigers won the World Series, 1984. I was just a young 9-year-old boy running around next to my next door neighbor's house, counting down the outs as the Detroit Tigers took out the San Diego Padres in Game 5 of the 1984 World Series. Who would have known 40 years later I would still be waiting for the Tigers to get that elusive World Series trophy back?
Hey, that's how Detroit Lions fans feel, though, too, about even just making the playoffs. And see, things happen. So,
true.
You can't throw on the ball just yet.
So, I know it's been a long time for those Tigers. We had some chances into the World Series, but that has nothing to do. Although if you with the price of sporting events now, you have to be a high marginal tax rate household to even afford to go to these dang games.
Ooh, just
now I sound like the old man on the porch telling you to get off my lawn.
You know what? At least and I'm not even going to make an old joke because you're not that much older than me. Let's be honest. I was gonna say, hey, back in the day, when last time they won the World Series, that was probably when you could, catch a home run, take the ball, and then they'd give you a free ticket to the game. But we're not talking about the 50s here. So we're okay.
That might be before my time.
That is that. I guarantee topic, that's pretty much before your time. But speaking of before people's time, right? So let's talk about this one. And this topic here, again, just to kind of reiterate, again, what it said in the show title, the description, and the intro, we're looking at those households, which makes up a huge percentage of the United States population, that averages less than $100,000 a year in annual taxable income. So we're going to look at those top tax strategies. But before we do that too, Chris, I want to mention, I forget what episode that we talked about this specifically, and I know we've done it multiple times, right? We talk a lot about tax planning and strategy and how some people think that, oh, that doesn't apply to me. I'm not making $500,000 or $1 million a year. That's like going to a country club. It's out of reach, some people think, for themselves. Well, the good news is the country club left their door open and unlocked in the middle of the night, and you can walk right in. So let's talk about why it's so important for even these households to tax plan, for lack of better terms.
It's very important for everyone to tax plan. And I always argue that the the lower to middle income, taxable income households, tax planning and strategy is more important than to someone in a higher marginal tax rate. Why? Well, the dollars are less, but the percentage of their income is more. And unfortunately, most tax planning and strategy focuses on your high net worth, higher income households. So we wanted to do this podcast. We had a reel on Facebook that got a lot of attention when we talked about this, and so I've broken down my 3 favorite tax planning strategies for these type of households. But before that, let's define what we consider lower to middle income households. In the teaching tax flow system, we believe that your marginal tax rate is your most important KPI. And it's important for many reasons, because there's a lot, not only is your tax, the amount of tax you pay, but the amount of credits you received, including child tax credits, earned income tax credits, daycare credits, all really depend on this figure, on a lot of them on your adjusted gross income or modified adjusted gross income. So what we would define as lower to middle income households is there anyone in the 12% or lower tax bracket. So for single filers in 2024, that number is approximately $63,000 of income, adjusted gross income, or less. And I'm taking into account the brackets. I'm also taking into account a standard deduction. For head of household taxpayers, that's about $84,000, $85,000 or less. And for married filing joint taxpayers, it's a whopping $125,000 of adjusted gross income or less. So that's the range that we're looking at. And for those type of taxpayers in the teaching tax flow system, we categorize them as a gold diagnosis, meaning that they can accept accelerated income. They're rather green diagnosis. And gold diagnosis, they should focus on tax-free income and growth. I want to point out one more thing, John. The amount of, these are facts. We have people in our private CPA practice that are absolute millionaires and still considered in a lower or middle income household, because income and assets are 2 different concepts. So this doesn't mean if you're in this situation that you are not wealthy. Some of our wealthiest clients are in these categories. So now that we define that, let's start diving in, because we talk diagnose, prescribe, IQ test, implement when we talk about tax strategy. So we've diagnosed you. If either you are in this category or you have a family, a friend, I want you to share this with them. What are the 3 things? And I try to pick out real basic strategies that anyone could do. You don't need to build a team of people to make them happen or implement. But what are the top 3 strategies for these type of taxpayers? In no particular order, except actually, now that I think about it, they're in order. I'm going to do my most favorite last.
There you go. And Chris, let's go back just briefly too. I know we touched on. So we always mention too, household incomes, tax bracket, marginal tax rate. So we're looking at, we say 100,000 and below for a household income. So we talk about it a lot, but let's reiterate it. What exactly is a household income to individuals, right? Families, individuals, how does it look?
Yeah, your adjusted gross income is really your taxable income. All right. So some things that are tax-free, like some type of municipal bond interest or what have you. And some of your income is taxed as net income. So rental income and in self-employment income. This is just an accumulation of all of your taxable income items, starting at the top with W-2 wages, all the way down to taxable Social Security, retirement plan distributions, bank interest, dividends, capital gains, capital losses. It could be gambling income. It could be any type of income when you add it up of what plays a role in making up your adjusted gross income. Now, we do know that different types of income are taxed at different rates, but to define the low to middle income households, we had to draw a line in the sand and say that range, we're talking about $65,000 to $125,000, depending on your filing status or less.
Perfect answer. And then also, we dive into these strategies, right? Are we going to, or does it really make a difference, right? Are we looking at, say it's a family of 2, or a household of two, say they're both W-2 full-time employees, say one of them's an employee, one of them self-employed. How big of a difference can we expect that to make as we get into these?
Well, I mean, it's self-employment. If you're self-employed, you're paying the self-employment tax, which is going to be an extra 15.3%. So yes, someone that makes $100,000 of self-employment income versus someone that's a W-2 at $100,000, their federal tax they pay is going to be the same. Yet the self-employment tax for the self-employed person is going to be 15.3%, where the employee is going to pay only half of that through their payroll. Now, the self-employed person, though, can offset their income with home office deduction and any type of ordinary and necessary business expenses.
Perfect. All right, so I won't do a drum roll in this podcast, but let's dive into it.
All right, number one is a health savings account contribution for quite a few reasons. Now, you might be saying, wait a second, you just said that these folks aren't necessarily worried about tax deductions. And I would agree, right? We're more worried about tax-free income and growth. Yet, because the typically people with this income level do not itemize their deductions, and even if you itemize your deductions, the medical expenses are very limited, and they have to exceed 7.5% of your income. So, just numbers wise, most of the people that this situation applies to, which is, by the way, the vast majority of people in this country, do not get a deduction for out-of-pocket medical expenses. So you might as well make that health savings account contribution if you're going to have those medical expenses for at least your deductible, and take that off the tax return, because you will, maybe preserve, again, some child tax credits, some earned income tax credits. And since you're not getting a deduction for it anyway, you might as well utilize that health savings account contribution if you are eligible. Shameless plug. We have other content on health savings account contributions, and there's a advanced tax strategy where you could do a one-time conversion from an IRA to an HSA. But again, that goes beyond this conversation. My point is, health savings account contributions, a great way to at least get a tax deduction. Even if it's $1,000 a year and that's your deductible, take advantage of it. Put the money in an HSA account. It grows tax-free if you use it for medical expenses. The other thing is, typically people with lower to middle income households, it's very hard for them to have a savings account designated just for unexpected health expenses, dental expenses. So to have that bucket separated out in a tax efficient way is very good. So John, for instance, if there's a married couple, let's say they have a teenager, and let's say their taxable income is $80,000 a year, or gross income. So their taxable income is maybe $55,000. If their child needs braces and it's $3,000, having that health savings account set up with the money in it is going to be a huge stress relief for them, versus if you have a household that they make $800,000 a year and their child needs braces, they probably don't take a second thought at saying, okay, just get the braces. So that's why I'm saying tax planning is so important for these type of households.
It's almost like you get it, in layman's terms, you get much more bang for your buck, or efforts, we should say, right? And honestly, Chris, going back and I'm trying to just recall what episode that was where we really dove into it. It was pretty early on, where we really, really kind of drew the line in the sand on, or I should say we erased the line in the sand actually, on who tax planning and strategy is most beneficial for, who can take advantage of it. And I'm not going to lie, I was even shocked at the end of that. I'm like, okay, well, this is definitely a lesser known fact in the wonderful world that we live in, right? A lot of people,
about a year and a
think
half
it's
ago,
gated.
that first year end of 2022, we went through each of the 4 diagnoses, red, green, purple, gold, and we talked through our favorite strategies for each diagnosis. So HSA is really a red strategy in the teaching tax flow system, but also gold, because there's tax-free growth and distribution. So you might be thinking of that. We did a 4-part series where we went into each color-coded diagnosis, which segues nicely into my number 2. This would be retirement plan distributions. Now, I'm going to put a caveat in here. This assumes you're not paying a 10% early distribution penalty from your retirement plan. We highly recommend avoiding that. But if you are in a situation where you can take money out of your retirement account and you are still in a low marginal tax rate, that's when you would accelerate income, meaning you are a green diagnosis. Green means go. Let me give you an example, John. Let's say you've got someone, we both grew up in the Detroit area, right? Commonplace. Let's say you've got somebody, and we're not going to name names, but these are former clients, right? They started working they're deceased now, first of all. So it's not like we kicked them to the curb. Baby boomers drafted to Vietnam, went to Vietnam, came home at age 21, started working at the big 3, put in 30 years, retired, full pension at 51. Okay. Now, does that happen anymore? Not really. They can't really take money out of their retirement accounts. Well, they are till 59 and a half, let's say, or there's creative ways they could out of their 401k. But the point is, they're age 51. They have a lot of money in their 401k plan. They've been saving diligently. They paid off their modest home. They aren't going to see Social Security income for 15 years plus. So ultimately, let's say they're getting a pension from General Motors or Chrysler or Ford of $40,000 a year. And they don't have any expenses. And when I started this 20 years ago or so, there are people like that out there, right? Their home was probably living a $60,000 home, paid off, $40,000 a year. But my point is, right now, they would pay all of $2,000 of federal tax per year because of the standard deduction. In that case, even if they didn't need the money, they should start taking money out of their 401k plan early. Not early, but now. They wouldn't, assuming they don't have a 10% penalty, and just put it in savings or do something with it. Because at some point, if that money continues to grow for the next 19 years and they have to take it out using a required minimum distribution, it's going to be probably taxed at a higher rate, and their Social Security could be taxed. So the point is, there are a lot of people, or there are people, that could take money out of a retirement plan that are real estate professional status, and because they have a huge, cost segregation study, again, remember I said you can have a low taxable income and be extremely wealthy. So in that case, a retirement plan distribution might make sense. So taking money out of your retirement plan, assuming that you're not paying the 10% penalty, in the same year that you have a low amount of taxable income, is my number 2 strategy for lower to middle income households.
And before we get into the third one, if our listeners feel maybe a little overwhelmed or a little confused right now, totally fine. I'll give you a fun fact that'll make you feel a lot better, right? So, we mentioned a couple of times now, you gave the example of back in the day, quote unquote, back in the day. Think about it this way, right? You might be overwhelmed at this very moment, but at least you're also not our parents / grandparents who were paying 14 to 17% interest rates on homes. So that is a plus. Kind of unrelated to this, but we take a little comedic
Well, I
break.
think it does relate though, because those folks would, because the interest rates were so high, they would want to pay their mortgage off as quickly as possible. And lending was different then. So, right. So yeah, that's so in those cases we work on those type of plans and take those retirement distributions. There are certain situations where you can take money out of a retirement account early, and you get an exception from that 10% penalty. So definitely work with a tax professional. Don't just wing it on your own. But these are that's my second strategy for these type of households. Now, number 3, using Roth accounts. And there are 2 ways you can use a Roth account to your advantage. One of them is, I'm going to call a cousin of the second strategy, a Roth conversion. So it is a retirement distribution account, but it's, instead of it coming into your pocket, that money, you are converting it to a Roth. So there won't be a 10% penalty, but now you have that money growing tax-free. And this is a strategy we use all the time. Excuse me. Because, real case in point, we are working with a client. Client average income was about $550,000 over the last 4 years. Socked away a lot of money, made great investments. Client's going to retire in about 8 years, and they want to spend time with their kids, so they're going to take a sabbatical from work, and they live within their means. They could take a year and a half off from work with very, very little taxable income. Yet they were making over $500,000 just last year. In that case, Roth conversions is a great option for them because they have a dependent. We can move every year $125,000 of money out of their retirement IRA or 401k into a Roth and paid maybe $10,000 worth of tax. And now that money is going to grow for them, tax-free the rest of their life. So the Roth is my third strategy. The Roth conversion, cousin of retirement plan distribution, is one component in Roth contributions. Oh, I'm going to get, John, it might make, when I hear 1099 employee, you know how I get set off like a firecracker.
Oh my gosh. Yeah. That's like somebody showing up late to a meeting with me.
Right. Something that might set me off worse is when I see usually younger, but it doesn't have to be younger, taxpayers with a low marginal tax rate. So they're in this group that we're talking about, 10%, 12% marginal tax rate. And because they got to work the first day, signed up for the 401k plan, they're putting money in their 401k plan. I'm not saying that's a bad thing, but why don't you put it into a Roth? If you're 30 years old, teachers, I see this a lot because they go sign up, they're excited to start work. First thing they do is put it in. I know they don't have 401k plans for teachers, but put it in their 403b or 457 plan and get a tax deduction. They're not paying any tax, right? Let's say they're making $50,000 a year. They're paying for their medical insurance pre-tax. Ultimately, they're getting peanuts of it. Let's say they put $3,000 in, and they get a $400 tax benefit right now. Big whip. Put it in your Roth portion, right? Because that $3,000, I know I've done this calculation before on the fly, not the smartest thing to do, but let's say that money's going to double, 5 times before they retire. 3,000 is 6, 12, 24, 48, 96. Would you rather have $96,000 in your retirement retire tax-free, or an extra few $100s in your pocket now? And you have to pay tax on all that money when you retire. So Roth contributions are part of my number 3 strategy for middle to lower income. The IRA contribution or traditional 401k really doesn't do you that much good. And for those people, a lot of them get a retirement savers credit on their federal tax return. Roth contributions are eligible for that retirement savers credit.
Well, pretty good, man. I know there was those 3, and I'm sure if we really poked and prodded you, we can get a couple more out of you, but we'll let you off the hook. And again, I really like this topic because I know a lot of the topics we do here on the podcast, obviously it's content that's coming from our community, coming from our audience. So sometimes it tends to get a little skewed towards higher income earners, real estate investors, etc. So I love these ones that really have a little bit of a wider wingspan, if we will, a little wider reach, a lot more of those average household incomes. And plus, Chris, going back, thinking about a year and a half ago, right? Well, even now we're episode 82 in. Our goal, even when well before we launched this podcast, right, was to make as much of an impact as we possibly could through teaching tax flow with taxpayers. So educating them of opportunities that are out there, and really putting the power in their hands, and in a non-aggressive way, but taking it out of the IRS's hands enough, right? And I'm going to quote you on this one, right? If you don't tax plan and take advantage of a lot of the strategies, the IRS will pick your tax. So if you don't pick your tax, they will, and they're never going to pick it in your favor, right?
John, I'm very proud of you. This is a proud moment. Yep, you pick your tax, or they do. You don't, and if you don't pick your tax, they're going to be. Or Sometimes we say yours or theirs. What does theirs spell? The IRS.
Ooh, that's just nasty, isn't it? It sounds dirty, but no, but I mean, take that to heart. Anybody who's listening to this, again, I know some of this might seem a little bit overwhelming. If you've never really dove into this at all, we are here for you. Please drop us a line, connect with us. We are an excellent resource. If you haven't taken advantage of it yet, even just sign up for a basic teaching tax flow membership. It's free, completely free. So you got a bunch of courses on there you can take. You can dive into this content. Obviously, this podcast we do completely ungated. We release it into the wild for free for everybody because that's what we're here for. So we extrapolate the information from Chris's head every once in a while and just throw it out there into the ecosphere. So, Chris, we appreciate it, man. Thank you for running through those with us.
My pleasure. It feels good to do these type of things for different types of taxpayers. And like I reiterate, like you said, jump into our either LinkedIn group or private Facebook group and let us connect you with the people that can help you execute these strategies.
Awesome. And before I close it out, as I always do, I want to make a very good point, very strong point here. Chris does not know this one's coming, but I can always tell when he's super, super in tune with what we're saying because he doesn't mention pickleball. So on that note, see you back here. Same time, well, different time, same place, different topic, back on the Teaching Tax Flow podcast. Thanks for hanging out with us, everybody. John here from the Teaching Tax Flow team. We let Chris off the hook here. He is out probably playing pickleball on the courts. I'm slowly getting in tune with the terminology. Heck, I feel like I know more about taxes than I do pickleball hanging out with this guy, but he's trying to change that. I promise you that. But in all seriousness, again, this topic is something that maybe it's a little intimidating. I know we mentioned that a couple times in the show if you haven't been exposed to it yet. But again, that's what we are here for. That literally is our mission with Teaching Tax Flow. So a couple resources for you I will throw at you here in the outro, but also drop them in the show notes. You have our Defeating Taxes. That is a private Facebook group started by Teaching Tax Flow. Chris, myself, the team, there's a lot of tax pros on there. There's a lot of taxpayers on there naturally. So post your questions on there. You can do it anonymously too if you had a question you did not want the world to see your business. But I promise you, there is a lot of brain power in that group. And the easy thing for us is we don't even have to monitor it. We don't have to slap anybody on the hands for saying anything inappropriate. Everybody there is there to help. Also, as mentioned, sign up for that free Teaching Tax Flow basic membership. The link is in the show notes. Again, completely free, no strings attached. Guarantee you'll pretty much learn something from that. It's very easy to navigate. If you have any questions or looking for something specific you cannot find on there, it's probably in there. We have a ton of courses. Shoot us an email, drop us a line on any of our socials. We're happy to guide you in the right direction. And if it's something that we don't have on there, even better, maybe it'll be a podcast episode. Maybe it'll be a course. That's, again, what we are here for, to help everybody out as taxpayers and taking the power away from the IRS in a non-aggressive, legally and ethically manner. Doesn't sound right, but you get what I'm saying. All right, everybody. We will see you back here next week. As mentioned, new topics. Looking at the roster, we have some fantastic ones for those real estate investors and just the general taxpayer. We got a great lineup of guests. Talk to you soon.
Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.